Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 6 of what is now going to be my 7-part video series on Roth IRA conversions. In this video, we are going to discuss 4 different topics related to your Roth IRA conversion decision and transaction. Topic number 1, we are going to look at the first of our cash flow generating assets and how we can begin thinking about these things in the context of doing Roth conversions. Topic number 2, we are going to talk about inherited traditional IRAs and how the RMD income that is generated by these inherited vehicles can be estimated and included in the personal tax planning template as we calculate our conversions. Topic number 3, we are going to talk about a major update to the personal tax planning template that a lot of folks have been asking about and waiting for, and it's the ability to apply a different set of tax brackets to each year included in your Roth conversion planning. This will allow you to analyze the impact of number 1, the widow's penalty, which is a topic that we will be discussing for the first time in this video, as well as the impact of number 2, the possible sunset of the Tax Cuts and Jobs Act and what that might do to your planning strategies. And this update is huge because it will allow us to fine-tune our conversion calculations for number 1, changes in tax brackets, number 2, changes in tax law, and number 3, changes in filing status, all of which will likely occur at some point throughout the course of your life. Finally, topic 4, we're going to cover the next step in what we started in video 5, where we said, hey, IRS, my income is not generated pro rata. And we're going to do this using our all new annualized income installment method calculator, which is designed to save you thousands, potentially even tens of thousands of dollars in dings over the course of your life by honing in on when is the most appropriate time to make the annualized income installment method election so you can have your estimated taxes based on reality and not on the IRS default assumption, thus minimizing underpayment penalties and maximizing the cash you keep in your family's pocketbook instead of, just like unnecessarily handing it over to the government. With that said, let's jump in. And by the way, if you enjoyed this video, please like and subscribe and let me know in the comments what's going on in your personal tax planning situation. All right, we're going to start today's video with an example involving 2 families. We have the Henderson family and we have the Johnson family. Now, both families have combined W-2 wages of $100,000 annually. Both want to do $20,000 annual Roth IRA conversions for 5 years in a row. Both have $30,000 of outside funds available for discretionary purposes, and both want to use outside funds to pay the tax on their Roth conversions instead of withholding funds that are coming out of the traditional IRA. So let's start with the Henderson family. Now, the Henderson family decides they're going to pay the tax on the $20,000 annual Roth conversions using money from their $30,000 pool of outside funds. They will also invest the remainder of the outside funds at the risk-free rate of return. The Johnson family, on the other hand, decide they're going to use their $30,000 pool of outside funds as a down payment on a rental property in a reputable part of town. They pick up a $300,000 property with $30,000 down and finance the remaining $270,000. They install a tenant at $2,650 a month rent. Their intention is to use the free cash flow coming from the rental property asset to cover the tax on the Roth conversions. They will then invest any remaining free cash flow at the risk-free rate of return. So let's start the number crunching with the Henderson family. Here is the Henderson family's taxable income calculation. We have the W-2 wages, that's $100,000 of income. We We have the standard deduction of $29,200. This is for married filing joint 2024. That's going to go against this income, leaving taxable income of $70,800 of the W-2 wages. Then we have the Roth IRA conversion income of $20,000. There is no standard deduction left because that all got used up here, so that's $20,000 of taxable income. The $70,800 plus the $20,000 gives us a total of $90,800 of taxable income for the Henderson family. So let's take that $90,800 and go down here to our 2024 estimated tax calculation. As you know, if you've been watching this video series, the first $23,200 of taxable income will be taxed at the 10% rate. So that's $23,200 times 10% is $2,320. The next up to $94,300 will be taxed at the 12% rate. Although we don't have that much taxable income in total, our total is $90,800 in this example. So we're going to tax the remaining $67,600. When you add these two numbers up right here, you get our total of $90,800. This $67,600 will be taxed at 12% for tax of $8,112. Grand total $10,342. Now the reason that I said that this is version 1 of the calculation is because I want to go down here to another version, and you're going to see that both of these get the same total tax. However, what I want to do is break out the W-2 income from the Roth income so that we can really isolate what the tax effect is of this $20,000 on the Roth conversion. So in this version of the table, the first row, the 10% row, is going to be the same. We got the 23.2 times 10%, 2,320. That's the same as up here. What we're going to do next is we're going to take the remaining portion of the W-2 wages, which is $47,600 for a grand total of $70,800. And again, where did that number come from? It came from right here. That's the total taxable income specifically related to the W-2 wages. So I'm going to take the remaining amount that we need to get to $70,800. That's going to be taxed at the 12% rate for $5,712 of tax. Now I want you to notice right here that I did not go to the next bracket. This actually is the same bracket. The reason I have it listed twice is because I'm trying to separate this kind of income from this kind of income. So this $20,000 of Roth income is also being taxed in the 12% bracket, but we have it on its own row so that we can see specifically it's $2,400 of tax related to this conversion, independent of what's going on with the W-2 wages. And again, as you can see, the $10,432 of tax in this example is the same between version 2 and version 1. This is just separating out the different kinds of income. All right, next we are going to look at cash flow related to this situation, and I want you to note two things going forward. Number one, since the W-2 wages are going to be identical between the Henderson and the Johnson families, we're just going to leave that out of the cash flow analysis so that we can specifically focus on just the things that will be different between the two families. And then related to that, number two, we are going to assume that all tax specifically related to the W-2 is covered by withholding via the paycheck. In other words, we don't have to use any of our outside funds that we're analyzing in this example to deal with the tax on the W-2 income. That's going to all be handled through withholding, and this whole situation with the W-2 income and tax is going to be identical between the two families, so we're just going to analyze the stuff that is different. All right, so here is our 5-year cash flow analysis, excluding the W-2 income and related withholding, like I just said, for the Henderson family. Remember, we're doing a 5-year analysis because the goal of both families was to do $20,000 Roth IRA conversions each year for 5 years. So the Henderson family, on January 1st of the first year, they had $30,000 of outside funds available, and we said that they're going to invest those at the the risk-free rate of return, which we will just assume is 5%. That's pretty reasonable these days. You can get 4 to 5% just on cash without even locking up the money for any time period. So that's a pretty reasonable rate, but you can certainly adjust that to whatever you think is appropriate when you're doing your analysis. So we have $30,000 invested at 5%, gives you $31,500 after 1 year of investment. That's a return of $1,500. Now there will be tax on that interest income. So that tax is going to be at their marginal rate, which is the 12% rate. So $1,500 times 12% is going to give you $180 of tax specifically on that. I just subtracted this number, the starting number, from the final number and multiplied the answer by 12%. So that's the tax specifically on this growth. Now, tax on the Roth conversion, we already calculated up here to be $2,400, specifically for that $20,000 conversion. So we have that down here, and they're going to use these funds. That was what the Henderson family planned to do, to pay that tax. So for the first year, they started at $30,000. They grew the money up to $31,500. There was $180,000 of tax on that interest income. They used $2,400 of the funds to pay the tax on the Roth conversion, leaving $28,920 at the end of year 1, which carries to year 2, and then the process will continue. Grow that by 5%. There's tax on the interest income. $2,400 goes to pay the tax on the conversion. $27,792 is what's left at the end of the second year, and that process goes on for year 3, year 4, year 5, and at the end of year 5, what the Henderson family has left is $24,103 in this account. They paid $832 of tax on the interest income that was earned by investing the balance at the risk-free rate of return, and they paid $12,000 of tax to do the Roth conversion. So let's summarize the Henderson family's result. The Henderson family converted $20,000 per year times 5 years equals a $100,000 conversion into Roth IRA at an after-tax net cash outflow cost of about $6,000. In other words, the $30,000 that they started with right here, less the $24,103 that they ended up with after considering the rate of return and the tax that was due both on the gain as well as the Roth conversion. $6,000 after-tax net cash outflow to complete that strategy. All right, now let's look at the Johnson family. So the Johnson family now has a property that they are renting for $2,650 a month or $31,800 per year. I'm just going to say that that's $32,000 per year to keep the math as simple as we can. So here's a schedule outlining what the Johnsons are doing with their rental property. We have 2 columns here. This is going to be our cash flow column, and then this is going to be our taxable income or loss column. Now you'll notice that most of these items are the same. We have our rental income of $32,000, which we just talked about. You're going to have insurance on the property, property tax most likely, mortgage interest. If you recall, the Johnsons financed a significant portion of this property, so they will have mortgage interest. And generally at the beginning of a loan, the majority of the payment does go toward interest as opposed to principal. So we're going to ignore principal for the moment in this calculation, but we're going to analyze that in more detail over here in the mortgage calculator, because principal is discretionary in the sense that you can always pay more principal, pay down your loan faster, and also reduce the overall interest cost over the life of the loan. Whether or not that is a good or a bad thing to do will depend on your facts and circumstances, and we will analyze that more over here in the mortgage calculator. I also threw in some other expenses. Now, what is different between these 2 columns? That's going to be depreciation. What is depreciation? It is how you deduct the cost of certain assets, like buildings, over time. You know, it'd be great if you could be like, yeah, I'm going to buy a $300,000 rental property, and I just want to write the whole thing off this year. Well, that's nice. That'd be real nice if we could all do that. But the IRS is hip to your game, and they don't want you to write it off all in 1 year. So what depreciation is it's the method by which you write off that expense over time. So the Johnson's property is kicking off $5,000 of free cash flow before income taxes. It's also generating a $5,455 taxable loss under this fact pattern right here, with the big difference between cash flow and taxable loss being depreciation, which is a deductible expense for a rental property, but it is not cash. It is a non-cash expense. The cash went out the door when the rental property was purchased initially, but you never got to write it off like we just said right here. So now through depreciation, you are getting the write-off little by little over time. And because this write-off now has nothing to do with the movement of cash, there's no equivalent number in this column right here. Now, is a rental property always going to be set up this way where it kicks off positive cash flow and a taxable loss? No, it may not always be that way. It's going to be based on the facts and circumstances of the actual transaction, and you can lay out your numbers just like this to see what the actual results would be. But if you're looking for an ideal situation in a rental property, it would be nice to be able to set it up such that you get the positive cash inflow, which you can then use for any of your own purposes, including, for example, paying the tax on Roth conversions, which we're going to do in this video. And then you also get the tax loss at the same time. All right, so let's go down here to the Johnson family tax calculation. We have the W-2 wages, which is the same as the Henderson family of $100,000. We have the standard deduction of $29,200, giving us taxable income specifically related to the W-2 of $70,800. Now, the Roth IRA conversion income is also $20,000, just like in the case of the Henderson family. What's different now is that we have the rental loss. So as we calculate it up here in this fact pattern, $5,455. So I'm going to put that in right here as a negative number. So when we combine the W-2 wages plus the Roth conversion income plus the rental loss, we have $85,345 of taxable income per year for the Johnson family. Now, when I go down here to the estimated tax calculation version 1, again, the first $23,200 is taxed at the 10% rate, and then what remains is going to be taxed at the 12% rate, very similar to before. For the Johnson family, we're at $85,345 because they have that rental loss of $5,455 offsetting this income. So total tax for the Johnson family, $9,777. And then when we break that down into version 2, just as we did before, there's the W-2 income taking up all of the 10% bracket, some of the 12% bracket. There's the Roth income in the 12% bracket, and now we have the rental loss also included in the 12% bracket. So as we go forward, I'm going to think about these two things in combination because we're kind of looking at them together for purposes of this example. And that's something to keep in mind, that everything in tax is all related to each other. It's all connected. You don't really look at things in isolation when you're doing tax planning. You have to look at the big picture. That's why we have the personal tax planning template where we can lay out all the facts and circumstances of each person's situation and really see what's going on when everything fits together. So I'm going to think of these two things as one number. If you look down here, it's hard to see, but this is 1,745 is the combination of these two, and we're going to see that when we go to the next tab. All right, next let's look at the 5-year cash flow analysis for the Johnson family. Remember that this excludes the W-2 income and the related withholding, same as with the Henderson family. And recall that the Johnson family invested their $30,000 of outside funds into a rental property. So the balance that is going to begin growing at the risk-free rate of return for the Johnson family is 0 to start with, and then we'll add the $5,000 of free cash flow that's getting kicked off by the rental property asset, which we determined on the previous tab. We're going to grow that at the 5%, leading to $5,250. There will be tax on that $250 of income, just like there was in the Henderson family example. So at the marginal rate of 12%, that is $30 of tax. And then here is the cash that goes to pay the tax on the Roth conversion, offset by the tax benefit that comes from that loss loss on the rental property asset. This is the $1,745 that we determined on the previous tab. Right here, when I summed up the $2,400 tax on the Roth conversion plus the $655 tax benefit coming from the loss on the rental property, sum those up, that's the $1,745. And so there it is right there. And so the balance at the end of this year is $3,475. That's the $5,000 of free cash flow grown at the risk-free rate of return, offset by the tax on that income, offset by the tax that went to pay the Roth conversion, adjusted for the fact that we had a small tax benefit from the rental property loss. That gets us to the $3,475, which then rolls forward to the next year, and then we add another $5,000 of free cash flow. Now the combination of these two right here will then be grown at the 5% risk-free rate of return to get the 8899, and then there will be tax. There will be the same amount of tax and cash spent on the Roth conversion offset by the rental property loss, and so on and so on. Each year the process will continue until the 5 years is up, and at that point the Johnsons will have accumulated a cash balance of $18,973. They will have incurred tax on investing at the risk-free rate of return of $370, and they will have incurred tax on the Roth conversion offset by the rental property loss tax benefit of $8,725. So in addition to this $18,973 cash balance that the Johnson family has accumulated over 5 years using this strategy, what other value has the family built? Well, they have built equity in the rental property asset itself. So here's the rental property 5-year equity calculation. The original equity was the $30,000 that they put down on the property. Then over the course of the 5 years, the equity in the property grew by $15,778. And this specifically is equity that has grown based on the tenant making principal payments on the loan on your behalf. Additional equity in the property can be grown if some of this free cash flow or other cash from other sources went towards mortgage principal. And I have a section here where that information can be entered. We're going to look at that in much more detail on the mortgage calculator in a few minutes. All right, so considering the $18,973 cash balance that the Johnson family has accumulated, plus the total equity that they have in the property after 5 years, which is $45,778, it's time to do a preliminary results comparison for the 5 years between the Henderson family and the Johnson family. So we know that the W-2 earnings were the same. Both couples had $100,000 annually for 5 years, so that's $500,000. Both couples had the same tax on the W-2 earnings of $40,160. That's $8,032 of tax annually times 5. If you recall, the $8,032 of annual tax on the W-2 wages comes from this calculation back here where we have the W-2 income in its own column, and then part of the tax is calculated in the 10% bracket, part of it in the 12% bracket, and if you add up these two numbers over here, that's the $8,032 right there. So going back to the preliminary results comparison, both couples were able to complete their $20,000 annual Roth conversions for a total of $100,000 for each couple, so that's the same. Now here's where things start to get interesting. So from a liquid cash perspective, the Henderson family invested their $30,000 of outside funds at the risk-free rate of return, and they used cash from that balance to pay the tax on their Roth IRA conversions, and at the end of the 5 years, they ended up with liquid cash of $24,103. The Johnson family, on the other hand, took their $30,000 of outside funds, they invested it in the rental property. So what they ultimately invested at the risk-free rate of return was the $5,000 of free cash flow that the rental property asset kicked off each year. And after 5 years of that and paying the tax on the Roth IRA conversion, they ended up with liquid cash of $18,973. So from the perspective of cash liquidity under this this set of assumptions that we've been using in this example, the Hendersons are ahead by $5,000 using these strategies. Now, with respect to the equity buildup in the property, so the Henderson family did not invest in any property, so they have zero. The Johnson family, we determined, had $30,000 down, which became equity, $15,778 of equity that grew over the 5 years based on the principal payments made by the tenant, for a grand total of the $45,778. Now, I want you to take a look at these two rows right here, and I want you to tell me from a tax perspective, what is the difference in what we are talking about in these two rows right here? Let's take the Johnsons. Well, this amount right here, this $18,973, this is an after-tax amount, right? If we go up here to where that amount was determined, this $18,973 is after the tax on that interest income. It is after the tax on the Roth conversion adjusted for the rental loss. But the long and short of it is that this has already been taxed. This is an after-tax number. So I'm going to go back down here and I'm going to take off this little box and I'm going to say this is after tax. Now, what about this number right here? Is this after tax? No, this number is pre-tax right here, because this equity that we determined right here, this is wrapped up in the property. This is not liquid cash. You can't just access this cash immediately. In fact, the only way to access this cash, I mean, I guess you could take like a second mortgage or some kind of home equity loan on the property, something like that, but putting aside other loans and debt, the only way to access this cash is through what? Through a taxable transaction. And because what we need to access this cash is a taxable transaction, that makes this a pre-tax amount. Now, in addition to that, this is also a pre-liquidation amount, meaning that the taxable transaction in question really is going to be a sale. And so what is this not accounting for yet? Well, it's not accounting for possible changes in the market value of real estate. It is certainly possible that this rental property had a market value change during the 5 years that it was owned by the Johnson family. So we have to take that into account as well. So basically, this row is not yet complete. That is why I said this is a preliminary results comparison. We have a little bit more work to do on this number right here before we can truly see on an after-tax perspective which one of these strategies works out better, either for the Henderson family or the Johnson family. And the reason why I specifically wanted to call out the difference between this after-tax row and this before tax row is because, you know, in your life, a lot of people are going to throw a lot of numbers at you, and most of them are going to be pre-tax. And so I want everybody to put on your after-tax thinking caps so that when you're presented with information, you're like, is that a pre-tax number or is that an after-tax number? Because only the after-tax amount is what ultimately remains in your family's pocketbook, right? So if you're doing analysis and you're looking at pre-tax numbers and you're not realizing their pre-tax numbers, then guess what? Your analysis is incomplete, effectively, because you're not considering what the results are after tax. And then the last thing we have here in this preliminary results comparison is the tax paid on the Roth conversion offset by the rental loss in the case of the Johnsons, but not the Hendersons. So the Johnsons paid about $9,000 in tax, and that is the sum. If we go up here, that is the sum of this number and this number right here is the $9,095. And then for the Henderson family at $12,832, that is the sum of these two numbers right here on the previous tab. So the Johnson family is about $4,000 ahead, meaning they paid $4,000 less in tax, primarily because of that rental loss that they have on the investment property. And just keep in mind that that $4,000 difference still is preliminary because we have not calculated the tax that would be due on completing this transaction right here, but we will be completing that in just a few minutes so that we can see a full after-tax comparison between both families under these scenarios. Before we do that, however, let's take a look at how this rental asset scenario would be set up in the personal tax planning template. And I want you to take note that total tax paid so far by the Johnsons in this 5-year example is $49,255, which is going to be the sum of this number right here, which is the tax on the W-2 earnings, plus this number right here, which is the tax on the Roth conversion offset offset by the rental. The sum of this and this is the $49,255. So here we are in the personal tax planning template. Now, if you've been following along in the members area, you should have 2023 completely filled out and finalized, okay? 2023 is in the books. It's done. And so you need to get all of your numbers in here so this column agrees to your tax return as filed for 2023. Once you have this complete, this is the basis upon which we will be doing projections for 2024, 2025, and going forward. So this column right here is done. Now, for purposes of this rental example, I want you to take a look at these 5 columns right here. Now, in your projections and planning, you will certainly have many of these rows filled out. But for this rental example, I have cleared out everything in here except the specific facts that we just went through with the Johnson family. So you can specifically see how the rental asset would play out within the personal tax planning template. So let's go through it line by line. We have the $100,000 of W-2 wages annually for each of the 5 years right here. Now right here is the interest income that the Johnson family earned for each of the 5 years on that $5,000 of free cash flow that they invested at the risk-free rate of return. And where do these 5 numbers come from? Well, if we go back here to the Johnson family 5-year cash flow analysis that we looked at earlier, I'm just going to do a little side calculation right over here, and that side calculation is going to be simply the balance after applying the rate of return minus the balance before applying the rate of return. So for the first year, that's going to be $250. Then in the next year, it's going to be the same thing, except we just have to make sure to incorporate the starting balance plus the cash added as the amount right here that is being subtracted. Okay, so we capture everything: 424, 605, 795, and 992. So I'm going to take these 5 numbers right here and put those in the personal tax planning template. So here they are right here: 250, 424, 605, 795, and 992. The next thing is the Roth IRA conversion, which, as you recall, was $20,000 per year for 5 years. So we have that in here right there. Then I'm going to scroll down here a little bit further. We have the rental loss of $5,455 for each of the 5 years in this scenario. So there's the rental loss right there. Then I'm going to keep scrolling down all the way to the tax calculation so we can see what the total tax is specifically on this. And I'm going to add up, here's the total tax. I'm going to add up these 5 numbers right here. And that total, as you can see down here, is $49,255. And that agrees to our total tax paid by the Johnsons in this 5-year example of the $49,255, which we had calculated here in the initial example. Now, what are some factors that we haven't considered so far in this example? Well, the first one, as we mentioned before, would be the fair market value of the rental property. The value of the rental property asset can change, obviously, based on market conditions. So how can we do some scenario testing in order to determine what kind of tax and cash flow impact any changes in market value might have on this strategy? Well, the first thing we can do is set up a range of possible results. For example, let's say that over the 5-year period, there are 3 possible fair market value outcomes. The property was originally purchased by the Johnson family for $300,000. So let's say that outcome 1 is that the fair market value drops by $30,000, resulting in a fair market value of $270 at the time of liquidation. Outcome number 2 will be that the fair market value remains exactly the same at the time of liquidation. And outcome number 3 will be that the fair market value increases by $30,000 at the time of liquidation. Now, offsetting the fair market value or sales price of the property will be several things. The first thing will be the amount still owed to the lender at the 5-year mark, which in this scenario is going to be $254,212, and that's going to be the same in all 3 outcomes. And that is another figure that we will pull off of the mortgage calculator in just a few minutes so you can see where that comes from. Another common item would be real estate commissions on the sale. I have set this up such that the commissions are 6% of the sales price right here in all 3 scenarios. That's why it increases, because the sales price increases in each scenario. So we have 3% to the buyer's agent, 3% to the seller's agent. That's generally a customary amount for real estate transactions in the United States, but of course that is a negotiable item, and you could certainly change this percentage right here to whatever you think is appropriate in your region of the country or your specific transaction or your relationship with with the broker, or of course, if you are acting as your own broker, then this would potentially be zero, at least for the side of the selling agent. The next item we would likely include in scenario testing like this would be other kinds of closing costs. I threw in $8,000, which I think seems reasonable considering these sales prices, but you can certainly reach out to your agent or to the title company to get a more specific answer related to your actual facts and circumstances of the transaction. And finally, here we have the tax cost related to this transaction. This is tax on the gain that is associated with the sale of this property. Now, you might be looking at outcome one saying, wait a minute, this is a negative number down here. How can there be a gain? Well, we're going to go into the details of this tax calculation in just one moment. Right now, we're working on cash flow. And the key I want you to remember is that cash inflow outflow is often different than taxable income and loss. From a cash flow perspective on outcome one, we have a $270,000 sale for which we owe $254,000 to the lender. We have the real estate commission. We have other closing costs. Our tax cost is essentially zero because the gain is relatively small. And again, we're going to get to that in a second. But from a cash flow perspective, this is a negative outcome right here because of the decline in the fair market value of the property. So what we want to do in order to complete our after-tax cash flow analysis, remember we did a preliminary analysis earlier, but I said we still have to update it. This is the update of it right here. And so we're going to take the results from this table, and now we're going to do our final comparison right here between the Henderson family and the Johnson family based on a variety of possible outcomes for the Johnson family associated with the liquidation of the rental property right here. So let's go through it. So in the first row, we have the liquid cash, which is the same as in the preliminary analysis. The Henderson family invested their $30,000 at the risk-free rate of return, but used money out of that pool of funds each year to pay the tax on Roth conversions. Now, the Johnson family started with zero invested at the risk-free rate of return because they put their $30,000 into the rental property, so they were getting that $5,000 of free cash flow that was kicked off from the rental. That is what they invested at the risk-free rate of return. And so in all the scenarios, remember, they ended up with the $18,973 of liquid cash. But now when we add in the cash, which has now become liquid due to the transaction of selling the rental property, so if the Johnsons, for whatever reason, decided to liquidate under outcome one and there was a decline in fair market value, then they're walking away with a cash flow loss here of $8,488. And so the end result is that they are sitting at $10,485 of outside funds after 5 years, which is 56% less than the Henderson family that took a more conservative approach. Alternatively, if the Johnson family liquidated under outcome two, where the market held relatively steady, the real estate market over those 5 years held relatively steady, they're walking away with $13,508 of free cash flow after liquidating the property. So when you add that $13,508 to the $18,973, the Johnson family is sitting at $32,481 under outcome two, which is 35% greater than the Henderson family that took the more conservative approach. And then, of course, if the Johnsons liquidate under outcome three, where the market has appreciated in value and the property is now worth $330,000, then they're walking away with free cash flow from the transaction of $35,174, which when you add that to the $18,973 they had invested at the risk-free rate of return, they are sitting at $54,147, which is 125% more than the Henderson family. So if we zoom out on these results and kind of take the 30,000 foot view of what is happening here, the Henderson family took the conservative approach. They invested their money at the risk-free rate of return so they could build it up as much as they could while simultaneously using some of it to do Roth IRA conversions. They got the $100,000 worth of conversions done that they wanted to, and they ended up with $24,000 at the end of the 5-year period. period. Now, the Johnsons were also able to complete their $100,000 of Roth IRA conversions over the 5 years, but in the process of doing that, they took on a more aggressive approach using their outside funds. And of course, just like anything in the world of finance, the pursuit of additional return generally comes with accepting the possibility of additional risk. So which one of these scenarios is the right thing to do? Is it the conservative approach of the Henderson family, or is it the more aggressive approach of the Johnson family? And you know what my answer is going to be. Nothing is inherently right or wrong. There is only right or wrong for your facts and circumstances. In fact, the only thing that I believe is always right is to be as informed as you can before making financial and tax planning decisions, and to realize that all of your financial affairs are interrelated and interconnected with each other. Each component of your tax planning strategy impacts every other component of your tax planning strategy. So the only way to realistically know if something is good or bad for your facts and circumstances is to lay out all your numbers in an organized, concise fashion, just like we do in the personal tax planning template. That way we can really see, is this strategy good or bad for our facts and circumstances? And just as important, how does it interplay with everything else that's going on in our family's financial world? So next, let's go to the details of how we complete this tax calculation right here related to the gain on the liquidation of the rental property. All right, here is the tax on the gain calculation. So we're going to start with the sales price, which under the 3 scenarios is the $270, $300, and $330, just like we saw before. Now the next item is the expenses of the sale, and these are going to be from up here, right here, the real estate commissions as well as the other closing costs. These two are going to be deductible items for purposes of calculating your gain. So after I take those expenses out of the gross sales price, I have a net sales price here, $245,800 for outcome 1, $274,000 for outcome 2, and then $302,200 for outcome 3. Now the next step in determining the gain is to figure out how much the property cost us. We know that the initial purchase price was $300,000, but when determining gain, we have to adjust the initial cost by the amount of depreciation that we took over the full amount of time that we held the investment, which in this case is 5 years. So this property has accumulated depreciation over 5 years of $54,546, and these numbers are going to be the same in all 3 scenarios right here. Now I also threw in 2 lines here for improvements made to the property as well as tax credits received related to these improvements. And although we didn't talk about this specifically related to the Johnson scenario, I just want you to be aware that if you make significant improvements to the property, like for example, let's say you replace all of the windows in the property, then the cost of those improvements would be added right here to the cost of the property. On the other hand, if you got a tax credit related to those improvements, for example, let's say those windows that you replaced were the energy efficient kind for which a tax credit may be available. To the extent you got a tax credit on these improvements, you then subtract that amount from your total cost of the property. So if we take our initial cost of $300,000 and we reduce it by the amount of depreciation taken over 5 years, and then we adjust it by these items right here, which are not applicable in this particular example, we get our adjusted cost, usually called adjusted cost basis, of $245,454 in this example. And then the difference between this net sales price right here and this adjusted cost basis is going to be our taxable gain, which, as I mentioned earlier, is relatively small because the amount of adjusted cost basis and the net sales price are effectively the same. And you can kind of see that, like, the fair market value of the property dropped by $30,000. We also had another $24,000 of expenses related to the sale, so that's about $54,000. We also had $54,000 of depreciation. So those are about the same, and that's why the gain ultimately ended up being about 0. But that just happens to be based on the facts and circumstances of this situation. It doesn't necessarily mean that it's always going to play out just like that. So then in outcome 2 and outcome 3, we applied the exact same methodology. The only difference here is that in outcome 2, the sales price is $30,000 higher than in outcome 1, and outcome 3 is $60,000 higher than outcome 1, and therefore our gains, our taxable gains, are higher. But the mathematical calculation works the same way as we just went through right here in this column. All right, now it's time to apply a tax rate to the taxable gain that we just calculated for this transaction. And my question to you is, are we going to tax this gain at the Johnson family's marginal rate? In other words, their ordinary tax rates in the ordinary tax brackets? Or are we going to apply the capital gain rate of 15% generally? Or are we going to apply both the ordinary tax rate and the capital gain tax rate? The answer is, when you have a taxable gain on an asset that has previously been depreciated, which this rental property has been depreciated, usually you will end up using a combination of both rates. Okay, let's go to TurboTax. All right, so we're in TurboTax and I'm on form 4797, which is where you enter stuff about selling property and dispositions of assets and stuff like that. So I've entered the sale information for the residential rental property of the Johnson family. I used outcome number 3 for purposes of this example. So here's the gross selling price of $330,000 that we had in outcome number 3 right over here. And here is the total gain of $56,746 right down here, which we have right here, $56,746. You can also see the depreciation over the 5-year period of $54,546 right here, which we have right here, $54,546. As far as the calculation on this row 21 right here and this row 23, TurboTax set up their calculation slightly differently than ours, so I want to compare the two to show you that they're mathematically the same and get to the same result. In order to do that, let's compare our outcome 3 right here to the TurboTax version right here. So what TurboTax does is they keep the sales price at the gross amount of $330,000. Then they take the original cost of the property, the $300,000, which we have right here, and what they do is they add the expenses of the sale to this number to get $327,800. When I go back over here, you can see the $327,800 right here. Then what they do is they subtract the depreciation of the $54,546 from that total to arrive at $273,254 adjusted basis, which is what you can see right down here on this line 23, and ultimately they arrive at the same gain of $56,746. So we have $56,746, TurboTax has $56,746. I just wanted to make that clear so there's no confusion, since they're ordering these numbers in a slightly different order than we did. All right, so we're back in TurboTax. Now that we have the gain right here of the $56,746, it's time to see which tax rates apply to this gain. For that, I'm going to go over here to this Schedule D tax worksheet right here, Schedule D tax worksheet, and here's the $56,746 that we've been talking about. And I know this looks like a really complicated worksheet, and it is, but there's only one thing that I want you to see. I'm going to scroll all the way down here to this line right here, line 31. Multiply line 30 by 15%. That's the capital gain rate that applies to most things. 15% right here. Multiply line 30. Okay, so that's the previous line. On the previous line, in this example, we have $2,200. 15% capital gain rate is being applied to that for capital gain tax of $330. What I want you to see is, of the $56,746, only $2,200 of it is being taxed at the 15% capital gain rate. And the remainder, $54,546, is being taxed at the ordinary rate within this return. This $54,546 might look familiar. Let's go back to the spreadsheet. All right, so we're back on the spreadsheet, and here is the $54,546 that we were just talking about. And what is that number? It is the total accumulated depreciation over the 5-year period. And so of this total gain right here of $56,746, this much of it, the amount equal to the depreciation of $54,546, this amount is being taxed in the ordinary income tax brackets, and only the difference between this number, the total gain, And the depreciation, that $2,200 that we saw earlier, this is the amount that is being taxed at the capital gain rate. Now, why is that? Why is this amount being taxed at the ordinary income tax rates and only this amount being taxed at the capital gain rates? The answer to that lies in some brand new tax words that we're going to learn today. And those tax words are depreciation, recapture. Okay, now hold on. I know that may sound really complicated, okay? But let's make it super easy. Let's just walk through what this means, depreciation, recapture. Of your total gain on the sale of a rental asset or any asset that has been subject to depreciation in the past, okay? The amount equal to the depreciation you took in prior years will generally be taxed at your ordinary rate, not at the capital gain rate, okay? Again, the amount equal to the depreciation you took in prior years. Let's go back up here. Here's the total amount of depreciation that we took in prior years. Of the total gain, this amount that you took depreciation for in prior years will be taxed at your ordinary income tax rate. And only the excess gain, only the amount of this gain that is more than that will be taxed, which in this case is $2,200, will be taxed at the capital gain rate. Now for the English version of the tax words, depreciation, recapture, I have just put a brand new tab here right at the end of the video that contains my world famous cookie jar analogy. So if you want to understand what this is in really simple terms that you will never forget, make sure at the end of the video to watch the cookie jar analogy and you will always understand what this is, depreciation, recapture. All right, and the last thing I want to do in this section is just incorporate the tax on the gain into the full tax calculation. So let's walk through it. The first four items in this list we previously calculated right here. We had the W-2 wages in the 10% and 12% brackets. We had the Roth conversion in the 12% bracket. We had the rental loss in the 12% bracket. And now we have to include the gain, which is going to be broken out onto these three rows. So if we add up the income right here in 1, 2, 3, 4, the total of this amount right here is $85,345, okay? If we look back at the calculation we did earlier, here's the $85,345 if I sum up all of these right here. But as we know, the top of the bracket is $94,300, the top of the 12% bracket. So how much of the gain is going to go into this row? Well, it's whatever amount we need to fill up the 12% bracket. So if I click on this, we know the top of the bracket is the $94,300. We know we have $85,345 already in income in these four rows up here. So whatever the difference is between those two numbers, $8,955. That is the amount of the gain that is going to be taxed at the 12% ordinary income tax rate. Then what is going to go here in the 22% bracket? How much of the gain? Well, it's going to be the amount that we need to get from $8,955 up to the total amount of depreciation that was taken in prior years, which if we scroll up here, we recall was $54,546. So I'm going to go back down here, and in this cell right here, I'm going to take this number, $54,546. I'm going to subtract out the $8,955, and I'm going to get $45,591. So if I add this and this together, what should that equal? $54,546. This is the depreciation recapture right here on these two lines. The total amount of gain that is equal to depreciation taken in the prior years, which in this example is $54,546, that is going to be taxed at the ordinary rate. And then the remaining $2,200 in this example, which is what we need for these three numbers to total up to 56,746, which is right here, total gain 56,746. That excess over the amount of depreciation taken in prior years is what gets taxed at the capital gain rate. So we have our total tax here of $21,212. This calculation that we just did right here uses the brackets for 2024. So what I want to do, such that we have something to compare this to, is I want to do the exact same calculation right here using the 2023 brackets, because the 2023 brackets are all we have available right now in TurboTax. The 2024 edition of TurboTax generally won't come out until like early 2025. So let's just go through the 1040 real quick and make sure we have all of our numbers in there for the Johnson scenario, and make sure that we get to this exact same tax calculation right here. For 2023, it's going to be 21,721. All right, so I'm in the 1040. Let's start scrolling down to make sure we have all of our information in here. There's the $100,000 of W-2 wages right there. There's our Roth IRA conversion of $20,000 for the year. There's our capital gain of the 56,746 right there, which agrees to our spreadsheet over here. There's the 5,455 rental loss right there. And then when we get all the way down here to line 16, there is our tax right there, 21,721, which agrees to this right over here, 21,721. So as you can see, what is happening behind the scenes is that depreciation recapture is being applied like we saw earlier on the Schedule D tax calculation worksheet. This amount of the gain is being taxed in the ordinary income tax bracket, again, to the extent that depreciation was taken on an asset that you sold or otherwise disposed of, and the remaining amount above the depreciation that was taken in prior years is taxed at the capital gain rate. And that's how we get to the 21,721. All right, next I want to jump into our mortgage loan interest and principal calculator, because we had taken some figures off of this calculator for purposes of calculating the results related to the Johnson rental property. In fact, let's quickly go back and see what we were looking at. So right here, one of the first figures we took off the calculator was the equity increase that the tenant had paid on the Johnson family's behalf over the 5 years, and that was $15,778. If I scroll down further to our scenario testing on the liquidation, we also figured out that the amount that the Johnson family owed the lender at the 5-year mark was $254,212. And I pulled both of those figures off the mortgage loan interest and principal calculator. So let's just quickly run through how it works and then where to find the numbers that can be incorporated into your analysis. So the information that you need to enter into a mortgage loan interest and principal calculator is relatively straightforward. The first thing we need is the original amount of the loan. In the case of the Johnson family, that was $270,000. But of course, you can enter any number in here that you want based on the situation that you are analyzing. The next thing is the interest rate on the loan. In this case, I'm just going to say it's 7%. The next item is the payment, the monthly payment that will be calculated based off of this information right here. And that uses the PMT function in Excel. The first argument you enter is the interest rate right here, cell C6, which is this one right here. If you want the amortization schedule, which is what this is, to be set up by month, then you divide the interest rate by 12, like I'm doing right here. The second argument you enter right here is the number of months in the loan. In this case, this is set up for a 30-year loan, so it would be 360 months. And then the final argument right here is the original balance of the loan. In this case, cell C5, which is this, which is $270,000. Right here, I have a cell for an additional payment made by the owner of the property. You have certainly heard that if you pay your loan faster, if you hit the principal, that the total amount of interest paid over time can be significantly reduced. So you can experiment with that by putting a number in right here, enter the number as a negative number. For example, we can see that with no additional payment, the total interest paid over the life of this mortgage is going to be $373,603. That is correct. That is actually more than the price of the property. And so when you start playing around with analysis like this and realizing that if you just pay the minimum payment, the property over the full term of any mortgage is often going to be double or more what the actual purchase price is, especially when rates start to get up into the 5, 6, and 7% range. But that can be significantly reduced. For example, if I just type in minus $100 extra each month, let's see what happens to this total interest from $373,603 down to $305,536. So if I undo that, we went from $373 down to $305 over the life of the mortgage by making an extra $100 principal payment each month. So that's certainly something you could play around with and see if that would be beneficial to your situation and your after-tax cash flow analysis. All right, next let's go through the amortization schedule itself, which is this part of the worksheet down here. So this particular loan is for 360 months. So we will start at month number 360 and then work our way all the way down to 1 when you get to the bottom of this schedule. Now, the balance before any payment made is going to be the original balance of $270. That's where it's going to start. Then we have our monthly payment. That monthly payment reduces the balance to an after payment amount. If there was an additional payment, which we were experimenting with right here, that would be included right there. Let me type it in one more time so that you can see. Now the additional payment would be right there, and the balance after the payment would be reduced by that amount as well. Now that we have the balance after the payment, interest will be calculated on this balance each month. So in this case, we have $1,565 of interest being calculated on this number at 7%. And then the difference between the amount that was paid, the monthly payment, and the amount of that payment that went to interest will be the amount of principal that was paid on the owner's behalf by the tenant. Of course, if we pay additional principal, let me put in another $100 as well, that $100 goes directly to the principal. It doesn't go to interest. And so principal paid by the owner would start to be accumulated over here. And then after the first month is complete, the balance, which is this number right here, plus the new amount of interest will roll forward to right here to start the next month. And then the cycle will continue from there. Now up here in this results section right here, I have the amount of principal that has been paid in total by the tenant as well as by the owner if you're making additional principal payments. And I've just set it up to have 1 year, 5 years, 10, 20, and 30 years. Obviously at the end of the 30th year, the entire amount of principal should be paid off. So again, if we go back here to the rental property 5-year equity calculation for the Johnson family, I had said that the equity increase over the 5 years was the $15,778. And so that number comes from right here, $15,778. This is the amount of principal paid by the tenant on the owner's behalf over 5 years. Now, the other item we were looking at was the amount at the end of the 5-year period that was still owed to the lender. We're going to have to know what that is if we want to liquidate the property because that's going to impact our cash flow. In this case, it was the $254,212. So 5 years times 12 months is 60 months. So 60 months will have gone by, which means we're going to go all the way down here to number 300. This is after 5 years, we will be at month number 300, and there is the $254,212 that is still owed to the lender at the end of the 5-year mark. I also wanted to note that if you do make additional principal payments, for example, the $100 a month, then when we look over here, you can see the amount of principal that was paid by the tenant was $239,500 over the life of the loan, and there was an additional $30,500 paid by the owner. Again, the total will just be the purchase price, the total amount of principal paid. This $100 reduces the term of the loan from 30 years effectively down to 25.5 years and reduces that interest expense significantly like we saw before. And so by having a mortgage loan interest and principal calculator like this set up, you can analyze in detail the specifics of your rental property or even personal property situation and determine what is the best use of your cash. Is it to do a larger Roth conversion? Is it to pay down the principal on this loan and ultimately reduce interest cost over time? The answer to these questions is all going to be based on your facts and circumstances. It's all going to be based on your investment horizon, your risk tolerance, and your desire to seek additional return. Generally accepting the reality that that seeking additional return usually comes with additional risk. All right, next topic is we want to start our conversation about inherited IRAs. Now, real simple. What is an inherited IRA from the perspective of doing tax planning and Roth conversions? Well, it's just a stream of income that you will have to account for in conjunction with all of your other income and expense items when filling out your personal tax planning template. So let's divide dealing with inherited IRAs into two buckets. We have bucket number 1 here, we have bucket number 2 here. Now, bucket number 1, if you are any of these, a surviving spouse, under 21 years old, disabled or chronically ill, or you are less than 10 years younger than the person from which you inherited the IRA. For example, you are 60 and the person you inherited the IRA from was 65. If you meet any of the criteria in bucket 1, then there are possible exceptions to the 10-year RMD rules for inherited IRAs. In other words, if you are in bucket 1, there are possible ways to stretch the IRA distributions out over more than 10 years. On the other hand, you are in bucket 2 if you inherited the IRA from a parent or relative, which is the most common scenario. It doesn't have to be a parent or relative, but that's generally who it is. And you are not any of the categories in bucket 1. This is the key. As long as you inherited an IRA and you are not any of these, then the 10-year RMD rules for inherited IRAs applies to you with penalties starting in 2025 if you fail to take the RMD. Now for 2024, there is relief on the penalties for failing to take an RMD. That comes from IRS Notice 2024-35, which I have right here. What is IRS Notice 2024-35? It grants relief for failure to make required minimum distributions from inherited individual retirement accounts IRAs. In other words, you won't get dinged with a penalty for forgetting to do these RMDs in 2024. All right, now let's do a pop quiz. Question number 1, because there is now no penalty for not taking RMDs from inherited IRAs in 2024, does that push your 10-year RMD window out for 1 more year? For example, if you were supposed to take RMDs in 2024 through 2033, are you now allowed to do it from 2025 through 2034? And the answer is no. Your RMD window remains the same at 2024 through 2033. You still have to take all the money out of the inherited IRA by 2033. You will just have larger RMDs in the 9 years between 2025 and 2033 if you don't take an RMD this year. Follow? Let's do a quick concept check. So let's say that you have determined that your RMDs are supposed to be $90,000 a year from 2024 to 2033. I'm just going to keep the numbers nice and even, easy to use. Now, before Notice 2024-35, if you did not take this $90,000 RMD in 2024, can you be dinged with a penalty for not doing it? And the answer is yes. Now, after Notice 2024-35, let's say that you just decided not to take this RMD right here, or you forgot about taking it, or whatever. Can you be dinged for not doing it? Can you be hit with a penalty? And the answer is no. So if you forget to do this or you choose not to do it, you won't get dinged with a penalty. However, that does not extend your timeline out here past 2023. Instead, what happens is this $90,000 that you did not take right here, the RMD you forgot about in 2024, that's going to need to be taken in the next 9 years. So what I've done for this example is I've taken this $90,000 and I spread it out by $10,000 over the next 9 years. And so you can see the difference here is you have $90,000 of income coming from this inherited IRA for 10 years in this example. Now you have $100,000 a year over 9 years in this example here, assuming you didn't take the RMD in 2024. So what I want you to understand is that the 10-year RMD window itself is a separate thing from will you get dinged for not following your RMD window. In this example, the RMD window is the 10-year period from 2024 to 2023. That doesn't change because of Notice 2024-35. All this notice does is simply say that you won't get a penalty for not doing this RMD in 2024, but you still have to push that income into these future years and take it out of the IRA at some point within the window. Okay, question number 2. Because there is now no penalty for not taking RMDs from inherited IRAs in 2024, does that mean you should just forget about your inherited IRAs in 2024 and not bother doing anything, i.e. not bother taking any distributions until we get to 2025? And of course the answer is no, it does not necessarily mean that. The only way to know the most tax beneficial answer to that question, i.e. whether you should take a distribution or not and how much to take, is to base that decision on your facts and circumstances, including all of your other items of income and expense, etc. So let's go to the personal tax planning template and see what we can figure out. All right, so we're in the personal tax planning template. I have a new tab here for our inherited IRA calculator, and these calculations are going to be based off IRS life expectancy table number 1 for beneficiaries. This can be found in IRS publication 590-B, Appendix B. So the calculations in here are similar in concept to any RMD calculation, like our original RMD calculation for yourself and your own IRA. The big difference is that for your own IRA, your RMDs can be spread out from age 73 through the remainder of your lifetime, whereas with inherited IRAs, you're limited to this 10-year window. So how you're going to use this calculator is pretty simple. Enter your age at 12/31 of the current year, enter the estimated or actual value of the inherited IRA you received as of 12/31 of the prior year. Now, I said estimated or actual because if you've actually inherited an IRA, you put that value in here. But if you're expecting to inherit an IRA in the future, although you may not have actually inherited it yet, you can still do this kind of planning for when you think you're going to start receiving that income, or approximately when, because obviously you can't know exactly when it's going to happen, but in a lot of cases you may have some good idea that, let's say, within the next 1, 2, 3 years you're likely to inherit an IRA, and you may want to incorporate that into your planning now, even though it actually hasn't been inherited yet. So you're going to put that value in right here. You're going to put in your age right here. And based on this table, it will calculate what the RMDs are going to be right here over the 10-year period. Now, there's something very interesting I want you to notice about RMDs that are limited to this 10-year window. And I have a comment on that right here. Keep in mind that the 10-year window can cause the taxable income you must pick up from the inherited IRAs to balloon in the 10th year, so plan accordingly. So in concept, that's just like a balloon loan. With a balloon loan or a balloon mortgage, you pay kind of a fixed amount or a lower amount for a certain number of years until the end of the loan term, and then the entire balance of the loan is due all at once. That's called a balloon. This is basically the same thing, except instead of it being a loan, it's income coming toward you. So you have this certain amount of minimum income that you have to take over the first 9 years, and then whatever's left balloons in the 10th year. So when we asked question number 2, like, should I just forget about taking an RMD this year because there happens to be no penalty, so I'm just going to brush it off until next year? All you're doing effectively, if you do that, is pushing more and more and more eventually into the balloon. And then in this particular year, this number could be such that it'll push you into a tax bracket you've never been in before and may never be in again. And so in that particular year, all that income is going to be hit at the highest rates, and thus the question becomes, do we have room in our brackets back here in these earlier years so we can start taking more than the RMD. Nothing stops you from taking more than the minimum. So in this schedule, what I have here is an actual column, and this is just where you type in the amount you're going to take. This is the minimum in this example, but you could take 30, you could take 50, you could take 40, you can take whatever amount you want as long as it's more than this, and try to fill up those brackets in the earlier years so you don't get nailed with the balloon in the 10th year. If this balloon hits at today's rates, you have the potential to be getting up there into those 32, 35, maybe even 37% brackets. If Tax Cuts and Jobs Act goes away, then the top rate is going to be back to 39.6%, and a lot of this income could potentially get pushed up into that bracket. So the difference between 39.6 and possibly pushing some of this income forward, let's say fill up your 24% bracket, that's huge. So what we have to do after we figure out what the RMD is we then go over to our main tab of the personal tax planning template, and we have that row right here for inherited IRAs. Of course, if you have more than one inherited IRA, you can make another row for the same thing. But then we're going to link our inherited IRA income into the 10-year period right here based on the actual that we decide to take. And this will help us figure out if we can maximize our lower brackets in the earlier years and avoid getting hit with the balloon in the 10th year. And as I said, even if you haven't inherited the IRA yet, if you are thinking a couple years out, you may be inheriting one, and you can estimate, approximately what you think might be in there, or if you're managing your parents' affairs, maybe you know approximately what's in there. You put in some estimate right here, and you figure out what those RMDs are going to look like, even though they may not start for a couple years out, and then what is that balloon going to look like in the 10th year? And by doing that and adding that inherited IRA income to your overall tax planning, it will continue to give you deeper insight into whether you should, and the extent to which you should, accelerate income through Roth conversions into 2024, 2025, and maybe even the next few years, assuming you have room in the lower brackets here and are able to keep some or all of that RMD income out of higher brackets down the road. All right, the next item on today's agenda is the widow's penalty. Now, let's be real. Nobody likes to talk about the widow's penalty, except if you're like this client that I once had. She says to me, well, my husband's going to die first, and I'm not dealing with that widow's penalty, so we're getting these Roth conversions done right now as much as possible in the married filing joint brackets while he's still alive. All right, well, I mean, each family's different, right? What can I say? But nonetheless, whether people like talking about it or not, the widow's penalty is just one of those realities that most families will have to deal with eventually. And what is it? Well, it's very straightforward. When one spouse passes, the other spouse, assuming they don't remarry, will end up in the single tax brackets, and therefore will be subject to RMDs in the single tax brackets. But here's the catch. The value of the IRAs subject to RMDs doesn't change just because one spouse passed away. So let's do a conceptual example. Assume each spouse has an IRA subject to a $50,000 annual RMD. So that's $100,000 total RMD annually. And assume that's the only income they have for purposes of this example. If both spouses are alive, the $100,000 of income will be taxed in the married filing joint brackets. If one spouse passes, the surviving spouse will inherit the IRA from the deceased spouse, and the $100,000 total RMD will be taxed in the single brackets. Let's crunch the numbers. So here's a tax bracket table for the married filing joint rates. I'm just going to use 2024. Here's the RMD income. As we know, the first 23.2 gets taxed in the 10% bracket, and then up to 94.3 gets taxed in the 12% bracket, and then the remainder in this example will get taxed in the 22% bracket for total RMD income of $100,000. And the resulting tax on that RMD is going to be $12,106. Now here's the tax bracket table for 2024 for single filers. So in this case, the first 11,600 gets taxed at 10%, and then up to 47,150 gets taxed at 12%, and then the remainder in this example will get taxed at 22% for, again, the same $100,000 of RMD income, but this time total tax is going to be $17,053. So now we have two calculations to compare. The single brackets produce $17,053 of tax on $100,000 of RMD income, and the married filing joint brackets produced $12,106 of tax on the same $100,000 of RMD income. The annual difference in tax on the same RMD based only on which brackets it's being taxed in this example is $5,000. That is the widow's penalty, and that's generally going to be an annual amount, assuming that the surviving spouse has consistent income and RMDs over the remainder of their life. So in this example, you are paying in an extra, quote unquote, $5,000 to the government each year that you might have been able to get converted into Roth in earlier years while still in the married filing joint brackets, just by doing a little bit of tax planning. And with that in mind, let's check out how we can now finally have the ability to scenario plan for not only the widow's penalty, but for rate and bracket changes related to the Tax Cuts and Jobs Act within the personal tax planning template. All right, so we're in the personal tax planning template, and I've tried to fit everything that we need to see for this discussion all in one place. So let's check it out. So if you recall the way that the template was originally set up as far as the tax calculation goes, there was one set of brackets right here, generally the brackets that applied to the current year. And for purposes of our projections into the future, we were forced to use that one set of brackets. There was no way to grow it for inflation. There was no way to apply a different set of brackets year by year by year to test for rate changes and bracket changes that could occur due to the sunset of the Tax Cuts and Jobs Act. There was no way to test for widow's penalty. There was no way to grow the brackets for inflation. So we were limited in our ability to plan for all of those scenarios, but that has now been updated, and I think this is an incredible update that really allows you to hone in on these specifics. So let's go through how it works. All right, so the first thing is that now we can choose by year what set of brackets we want to apply, and there are 4 sets of brackets that we can choose from. We can either do single or married filing joint under the current law, or we can do single or married filing joint under pre-Tax Cuts and Jobs Act. And the way we select it by year is simply to type in what we want right here. So MCL just means married current law, and I just type that in right there. I type that in right there. Typically, married current law or single current law is probably what most people will pick for 2024 and 2025, because we know that it's unlikely that there's going to be any major tax legislation until the end of 2025. Now, starting in 2026 and beyond, this is where things can get interesting with the planning. So M-Pre means married under pre-Tax Cuts and Jobs Act law. Single pre would mean single rates under pre-Tax Cuts and Jobs Act law. And so what I've set up here for this example is I've done a couple, let's say the couple is married filing joint, and they're going to choose the current law for 2024 and 2025. Then they're going to experiment between current law, what happens if the law stays the same. In other words, Congress extends the Tax Cuts and Jobs Act, and let's just say for this example that nothing changes, they just extend it as is. So they're going to experiment between married current law and married pre-Tax Cuts and Jobs Act, and they're going to do that all the way out here to 2031. And then after 2031, they're going to scenario test, well, what if one spouse was to pass away? What would happen starting in 2032 if the other spouse went into the single rates, and it could be under current law under pre-Tax Cuts and Jobs Act, depending on what you want to test. For now, I've put in single under pre-Tax Cuts and Jobs Act for these 3 years out here. Okay, so So I have one set of brackets here, I have another set being tested right here, and then I have a third set being tested right here. So again, this is for right here, this test is for the Tax Cuts and Jobs Act possible sunset that could be coming up. And then when we switch to the single rates, this is testing widow's penalty. So now that we have our bracket selections set up for this test, let's talk about how to interpret the results. So if I've selected a bracket under current law, like right here and right here, then when I want to see what rate is being applied, I'm going to look over here in this column right here that says current law. On the other hand, if I have a pre-Tax Cuts and Jobs Act bracket being applied, like right in here, I'm going to look at this column right here to know what rate is being applied. So for example, in 2024, I have $40,404 of tax being determined at the 24% rate. On the other hand, in 2026, I have $20,475 of tax being calculated at the 25% rate, and I have $12,985 of tax being calculated at the 28% rate. So again, which column you look at right here, whether current law or pre-Tax Cuts and Jobs Act, will depend on if you've selected a current law bracket or a pre-Tax Cuts and Jobs Act bracket. Now, in order to determine how much room is left in the bracket that you're looking at, the only way to get all of this stuff to fit in one place was to set up a separate set of rows right down here for the brackets themselves. So for example, in 2024, if this is my marginal rate right here, that whatever the top rate that you're in is called your marginal rate for that particular year. So right now, under current law, I'm in the 24% marginal rate right here. So the question is, how much more room is left in this bracket? Well, to view this easily, I've created just a set of A through G. So this is in row D, so I'm going to go down here to row D, and I can see that the top of my bracket is $383,900 versus I have $369,400 of ordinary income so far. So let's just say that's 384 to make the numbers easy. Let's just say that's 370. So I have $14,000 of room still in the 24% bracket right here. Now, if I look at 2025 under this fact pattern, I can see that there's much less tax being calculated in the 24% bracket, which means I must have a lot more room because for whatever reason, I have less income that I've entered into the spreadsheet. So I'm still in row D. I go down here to row D, I see that the top of my bracket is $395,417. Now, the reason it's $395,417 versus the $383,900 is because I've applied an inflation rate. And I will show you how to do that a little bit later, but that's why these brackets are growing right here. At least till we get to the pre-Tax Cuts and Jobs Act when the brackets were much lower, and then you'll see a dip in the bracket right here, which still can grow for inflation going forward, but it's going to dip down compared to current law. So based on what we've done so far, we can see that this family has about $14,000 of room in the 24% bracket for 2024, and then a lot more room actually in the 24% bracket for 2025. Now, the next thing we want to look at is what happens if the Tax Cuts and Jobs Act expires and rates happen to go back to the old rates, and that's what we're testing here starting in 2026. So based on all of the income information that has been entered up here, we have tax being calculated again in the 25% bracket right here, this $20,475. Remember, we're in a pre-Tax Cuts and Jobs Act bracket, so I'm looking at this column. I have tax being calculated at the 25% rate, and I have tax being calculated at the 28% rate, and that is consistent for 1, 2, 3, 4 years. In fact, in this year, I even have some tax bumping up into the 33% rate. So if this is your fact pattern and you're testing what would happen if rates were to go back to pre-Tax Cuts and Jobs Act, and you're seeing tax being calculated in the 25, 28, and even a little bit in the 33% brackets, while at the same time your facts are supporting room in the 24% bracket for 2024 and 2025 under current law, then you certainly have an argument for considering the possibility of accelerating generating income through the use of Roth conversions out of these years right here and into these years right here where you could potentially get that income taxed in the 24% bracket as opposed to these higher brackets. Now, the same concept applies when testing widow's penalty. So if you recall, this couple decided to start testing widow's penalty in 2032, and to accomplish that, we simply enter one of the single brackets in the years that we want to test. In this case, we've chosen Single Pre-Tax Cuts and Jobs Act. So let's look at what these results are telling us. So right here, I have $17,000 of tax coming out of the 25% bracket. I have $7,000 of tax coming out of the 28% bracket. And under this fact pattern, this appears to be consistent right here over the 3 years that we're testing for this example. Now, at the same time, if we look back to the years that are right before this, and we could go all the way back to here, it doesn't really matter, but if we just look at these 2 years right here, the marginal rate in both of these years is 25%, because we have Pre-Tax Cuts and Jobs Act rates for married filing joint in here. So we're at 25% marginal rate, but have we filled the bracket in that case? We're in row C. Let's go down to row C. Let's scroll over. In this particular year here, I have $188,294 as the top of my bracket, but taxable income, ordinary income, is only at $125,700. So I have room here. I have room 182 for this year, 126,800 right here. I have room here as well. So the concept is the same. Widow's penalty is causing tax to be incurred at the 28% bracket, but I have room right here in the 25% bracket for 2 years, such that if I figure out how much I could put in here, I could potentially get some or all of this out of the higher bracket in these later years. Let's layer in something else as well. Take a look at this 2033 column for a second. We are maxing out at $22,000 of tax in the 28% bracket. Let's keep that in mind for a minute. I'm going to go back over here to our Inherited IRA tab. Now remember, we were talking about your inherited IRAs and how there's a high probability that they will balloon if you don't take out more than the RMD. And earlier we decided that our actual was going to be this, the numbers that we typed in here. But let's just say for a minute that you decide, you know what, I'm not going to do that. Instead, I'm just going to make my actual equal to my RMD. And I'm actually going to do that for all of the first 9 years. Okay. Now I have the balloon sitting in the actual, okay? So let's go back to the tax planning template. Let's look at our 2033 column. Let's go down here, and we were sitting at about 27,000, if I recall correctly, in the 28% bracket. And now look what happened. Because we did not manage the distributions out of that inherited IRA properly, we just got dinged with tax in the 33% bracket and tax on that balloon income all the way up into the 35% bracket. So if you have an inherited IRA, you want to manage those distributions, that income, as much as you can. It's probably going to have to be more than the RMD in order to smooth it out over 10 years, as opposed to a lot of it hitting all at once in the 10th year. By the way, everything you have seen in this video, including the mortgage interest and principal calculator, the inherited IRA calculator, and the dynamic tax brackets calculator, which will allow you to further hone and refine your Roth conversion strategy for the effects of inflation, the widow's penalty, and possible tax bracket and rate changes that could be coming with the potential expiration of the Tax Cuts and Jobs Act, are all included with your purchase of the personal tax planning template that you have seen me demonstrate throughout this entire video series. So if you are already a member, you can just log into the members area at your convenience and check it out. And if you're not already a member, the personal tax planning template is available for purchase at the link in the description located right below this video on YouTube. Your purchase helps out the channel and gives you a tax planning and analysis tool set that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocket. As always, you will get lifetime access to all the updates that I make to the personal tax planning template as well as the members area, so it's a win-win for everybody. Alright, I have determined that this video has reached capacity, except of course for my world-famous cookie jar analogy regarding depreciation recapture, which we will be covering in just a moment. So with that said, this is going to conclude part 6 of this video series. The all-new annualized income installment method calculator and explanation will be pushed into part 7 of the series. Part 7 will also include a variety of all-new topics that we need to consider as we build out, refine, and optimize our tax planning strategies in preparation for our 2024 and 2025 Roth IRA conversions. So please stay tuned for that. I hope you enjoyed this video. Thank you for watching. Stick around for the cookie jar analogy, and I will see you in part 7. Alright, welcome to my world-famous cookie jar analogy for understanding depreciation recapture. Here we go. I have 2 cookie jars. I have a large cookie jar and I have a small cookie jar. In the large cookie jar are large cookies. Large cookies are worth 24%. 24% of what, you might ask? It doesn't matter. 24% of anything. Let's just leave it at that. Large cookies are worth 24%. Now, small cookies, on the other hand, are worth 15%. They're smaller cookies, they're worth less. You come to me and you say, hey, I'd like to borrow 5 of your large cookies. I say, great, you can borrow 5 of my large cookies, but here's the deal. You need to pay me back later with 5 large cookies. You agree. You take your cookies and go. Then some months or years pass, and then ultimately the time comes to pay the piper. You owe me 5 large cookies. You show up to repay, and in your hand are 5 small cookies. You say, here's your cookies. Thanks for letting me borrow them. Have a nice day. And I say, no, I don't think so. As they used to say on the 90s TV show In Living Color, homie, don't play that. If you're going to borrow 5 large cookies, you're going to return 5 large cookies. You don't get to borrow the 24% cookies and then just return the 15% cookies. Okay? That ain't happening. Alright, that's it for the cookie jar analogy, and right now, sitting there watching this video, you understand everything you need to know about depreciation recapture. You just don't realize it yet, but you're about to. So let's do an equivalent example using a rental property. You purchase a rental property for $300,000. During the years you owned the property, you collect total rental income of $90,000 and deduct total depreciation of $50,000. Assume for this example you are in the 24% marginal tax bracket. When you report your rental income and expense on your tax return, the IRS assesses tax on your income and expense items as follows. You have income of $90,000 times the 24% marginal rate is a tax expense of $21,600. Offsetting that, you have $50,000 of depreciation expense being deducted at the 24% rate for a tax benefit of $12,000. Now, while the net of that is $40,000 of income being taxed at the 24% rate for $9,600 of tax within that calculation, the IRS gave you a tax benefit at your marginal rate of 24% on the depreciation deduction that you took. Now, when you go to sell the property, here is your original cost of $300,000. Here is your total depreciation that you took of $50,000, leaving you with an adjusted basis, it's called, of $250,000. Let's make the math real easy. Your selling price of the property is $300,000. Your adjusted basis in the property, which we just calculated right here, is $250,000, resulting in a gain of $50,000. Now you go to the IRS and say, hey, I want my gain of $50,000 which, by the way, was caused exclusively by the $50,000 of depreciation that you let me deduct at my 24% tax bracket, wink, wink, wink. I want that to be taxed only at the 15% capital gain rate. And the IRS says, no. IRS, don't play that. If we gave you a tax benefit at your marginal rate of 24% on a $50,000 deduction, then to the extent that you have $50,000 of gain, which again is because of that depreciation deduction, you're paying tax at your 24% marginal rate on that gain. So here are two scenarios to demonstrate. If the sales price is more than your adjusted basis, such that the gain is actually more than the depreciation that you took, in this case 325 minus 250 is 75,000, to the extent you took depreciation of $50,000, that is going to be taxed at your marginal rate. You have to give back the cookies at the same rate that you deducted the cookies at earlier. If there is excess gain above the amount of depreciation, in this case 25,000, that is what would be taxed at the 15% capital gain rate. And if there is no excess, for example, the sales price is $300,000 versus $250,000 adjusted basis for a gain of $50,000, then the entire gain is going to be given back at the 24% tax rate. The IRS giveth, but then the IRS taketh away. That is depreciation recapture.